Speaking of kicking off, let's kick off with the jobs report. The U.S. economy adding 206,000 jobs in June, and our next guest says that is exactly the kind of number the Fed would like to see. With the unemployment rate ticking up to 4.1%, he says the case for 2 interest rate cuts by year-end is even stronger. He's Gus Faucher, PNC's chief economist. Gus, welcome. Good to have you with us. This number, 206,000, is kind of a Goldilocks number. Not too hot, not too cold, I guess.
That's right. And we've seen job gains of about 175,000 over the past 3 months. That's close to the economy's long-term potential. And then we also saw a bit softer wage growth in June, which is what the Fed is looking for in terms of inflationary pressures there. So I think this report is pretty much what the Fed was hoping to see. And this does support some Fed fund rate cuts towards the end of this year.
Do you think that the Fed has threaded the needle of sort of arresting inflation but avoiding a recession?
It sure looks like that at this point. We still have good job growth. We have good wage growth. Wages are increasing more rapidly than inflation. So we should see consumer spending continue to increase through the rest of 2024. And we should see slower inflation. Shelter inflation should slow. The slightly softer job market should reduce inflation coming from the labor market. So it looks like we will get continued low unemployment and inflation that is moving towards the Fed's 2% objective.
So there's only about a 6% chance they could cut in July, Gus, which would be at the end of the month, 30th and 31st. Should those odds go up? I mean, why is the Fed going to wait till September?
They want to make sure that inflation is starting to slow again. So we made significant progress on inflation in 2023, and then that kind of stalled in the first part of 2024. We've had one good month of inflation readings in May. June should look good again, but they don't want just 1 or 2 months. They want 3, 4 months indicating that inflation is slowing and moving towards 2% before they move. So I think the end of July is too early, but September or perhaps November, I think, are both in play at this point.
Does the likelihood of an interest rate cut suggest that we're going to embark on a series of interest rate cuts, or maybe just a couple, 1 or 2 this year, and then more wait and see on the part of the Fed?
I think the Fed will move slowly, so we may see cuts at every other meeting, for example. I think that monetary policy is contractionary right now. It is weighing on growth, and that's what the minute said from the last FOMC meeting. That's what Chair Powell has been saying. But the officials they're not quite sure what the neutral rate is, the rate where it's neither adding to nor subtracting from growth. So they don't want to move too precipitously. They want to take their time. But I think given the strength of the economy, they can do that. And so they cut every other meeting. They see how the labor market responds. They see how inflation responds, and they can afford to be cautious with this.
Interesting you bring that up, because I don't know, you probably saw those comments by Williams within the last couple of days where he said he doesn't think the neutral rate is higher than it used to be. A lot of people think the neutral rate, because the economy hasn't slowed much on what they've done so far, neutral rate could be 3, 4, 5%. But he says, no, it's probably not much different from the low that we had expected it would be, which means policy now is really, really quite restrictive.
That's right. I mean, that may very well be the case, but it's certainly not. We're not seeing that in the economy, right? I mean, we still have good GDP growth. We still have good job growth. We don't know the answer to that question. The neutral rate is an unknown. We can kind of guess at it, but there may have been structural changes with the pandemic and the recovery that we've seen. So given that, that's a good reason for the FOMC to be cautious and to take their time cutting rates so that they don't cut too much and then inflation starts to pick back up again.